Good afternoon, everyone, and welcome to this session in our Ideas for Your ISA season. Global small caps is just a sort of allocation that could make a lot of sense for long-term ISA allocation. Small caps have huge return potential, but haven't lived up to expectations in the past 5 to 10 years. So potentially we have a growth investment which has been out of favor, which could be an interesting time to look at it. Shortly, we'll be hearing from Nish Patel, manager of Global Smaller Companies Trust. Nish will discuss the trust and the outlook for the asset class. The presentation should last for around half an hour, and we have 15 minutes reserved for questions at the end. Please do write any questions you'd like to ask Nish in the box, and I'll put them to him at the end. So with that, Nish, I'll hand over to you.
Great. Thank you very much, Thomas, and good afternoon to all of you, and thank you for your interest in the Global Smaller Companies Trust. Thomas, if you could pull up the slides, that would be great, and if we can move to slide 3. So some of you may be unfamiliar with this trust and may not have looked at it in the past, so I'll give you an introduction into what we do. So the Global Smaller Companies Trust is a London-listed investment trust, and our investment philosophy is very simple. We look to take a long-term conservative approach to investing in good quality growing small cap businesses. And we do this in an opportunistic way. We're looking to buy into these companies when they are out of favor and when they are available at a significant discount to what we think they are intrinsically worth. So this is very much a quality value strategy. So what is different about this trust? So first off, I'd like to say that it really does start with the people. And this is a very experienced and well-resourced team of small cap investors. There are 9 people involved in the management of this trust, and the average experience on this team is 20 years per person. And most of us have actually spent the majority of our careers looking at smaller companies. So we know the management teams really well, we know the companies really well, we know what's likely to work and what is likely to not work in this particular area. The philosophy is different. The good thing about smaller companies is that they have historically outperformed larger companies because these businesses are starting off from a lower base, and they are also not very well known by the wider investment community. So as they grow and as they are more familiar to investors, particularly institutional investors, they tend to see a valuation expansion that they benefit from over the longer term. The problem with smaller companies is that they tend to be riskier. So what we're trying to do is we're trying to offer to our clients the faster growth that is inherent within smaller companies, but we do that with lower levels of risk. And the way that we lower risk for our clients is that we focus on the higher quality companies within the small cap universe. And we buy into these companies when they are on a discount to what they are worth. So if we're wrong in our analysis, that discount or that margin of safety protects our investors on the downside. The other difference with this trust is that it is a one-stop shop. So we are offering smaller companies within the developed markets and also the faster growing emerging markets. And this is all in one vehicle. So you wouldn't have to make the decision on which region to invest in. We would do all of that for you on a very much on a bottom-up perspective. This is a truly small cap product. It is not a mid-cap product, and our size enables us to invest in the very small businesses that are quoted on the world stock markets. But at the same time, we do have sufficient assets to be relevant in the investment trust world. We know that is becoming harder and harder as the years go by, but we still have 818 million of assets, which makes us a scale player in this part of the market. We pay a dividend. We've raised the dividend for 54 years consecutively, and that's a record that we're really proud of, and we want to continue that long track record. It's a low-cost offering. We're under 80 basis points on an ongoing charge, and we are very active on the buyback. So we look to maintain a discount of 5% in normal market conditions. We are wider than that at the moment, so we are buying back our shares. We have bought back about 10% of the company in the last year or so. So Thomas, if you'd like to turn the page. So I think most investors will claim to be quality investors, or they'll look to invest in quality businesses. But I think that means different things to different people. So perhaps it's worth talking about what we think is quality business, a quality business. So first off, we invest in companies that we can fully understand. Now, this might seem like a basic observation, but it's amazing how many businesses aren't really that predictable in the small cap universe in particular. Many companies are loss-making. Many companies have unproven products, and we don't really know what these businesses might look like in 10 years' time. We avoid those sorts of instances. We don't really buy companies that are loss-making. For example, that the biotech business that has an unproven drug, or the technology company that has a product that doesn't even make any sales yet, those are companies we tend to avoid. We invest in companies that are fully understandable by us, where we have a high degree of confidence in what the company might look like in 10 years' time, and how to value that company, and where the risks are likely to come from. We invest in businesses that have really strong and sustainable competitive advantages. So that could be a differentiated product or a differentiated service or a low-cost producer of a particular good. We like businesses that are operating in industries that tend to have barriers to entry, because that tends to keep the returns high within that particular company. We like companies that are diversified by customer or product or by supplier. And I think that's really important in the small cap universe, because these businesses are small. So it's only natural that they will have a large degree of their sales from a smaller number of customers. But we try and pick the companies that are actually diversified. So if that customer goes away, there isn't a big problem for the business. We like companies with pricing power, and we think that's really important, particularly in an environment where we are seeing inflation that has been higher than in the past. Pricing power businesses are more valuable. Businesses that we invest in must generate cash flow, because that is not only indicative of good accounting quality, but the companies can use the cash to generate further growth in their per share intrinsic values. Financial strength is something that's really important, especially in an interest rate environment that is higher than has been in the last 15 years or so. We want companies with lower levels of leverage. When it comes to management teams, first off and foremost, the companies must have capable operators. They must be able to take care of their day-to-day operations with minimal surprises. They must have a track record of good capital allocation, and their decisions must generate long-term shareholder value. We particularly like companies where the management teams own quite a lot of the company themselves. So in that way, our interests are all aligned, and the company is likely to make decisions that are favorable to their shareholder base. We want management teams that are prudent, that don't take excessive risks. And we also want our management teams to be honest with us and transparent with us, because many times, especially in smaller companies, things do go wrong. And when they do go wrong, we want the management teams to own up to their mistakes, and to come up with a sensible plan to rectify the situation. So that is what we think is a good quality company and a good management team. The issue is that a lot of the time, these companies are well known to the investment community, and they tend to have high valuations. The trick for us is to try and identify these companies beforehand, and to buy into them when there is a temporary problem or when the shares are out of favor for one particular reason that we think is resolvable. So we are opportunistic and we are contrarian, and we look to buy into these companies when they are at a discount to what they are intrinsically worth. And we will use a whole host of different valuation metrics. For example, multiples of earnings, multiples of EBITDA or book value, discounted cash flows, private market valuations. But we want a wide discount to be able to buy into the company. Thomas, if you turn the slide. So this does, our quality value approach does show up in the numbers. So if you look at our portfolio on a median basis and you compare it to the benchmark on a median basis, we do have better quality metrics. Quality metrics are shown by gross margin, operating margin, return on equity, and net debt to EBITDA. You can see that our gross margin is 3.7% ahead of the benchmark. Our operating margin is almost 2% higher, and our returns on equity are over 2% higher. We have lower levels of leverage as well. At the same time, we're offering this to our clients, these companies to our clients, at a lower multiple of sales and a lower multiple of earnings and a higher dividend yield. So what we are doing from a bottom-up perspective is showing up in the overall portfolio characteristics. You turn the slide, Thomas. So turning to performance, these are the numbers over the last 5 years or so. It has been a difficult period for active managers. Momentum has been the dominant factor that has been governing the markets. Quality value has lagged as a style. Value has been very out of favor. Value actually lagged growth by about 2% again last year. So we are behind the benchmark over the last 12 months. We did have performance in the UK that was behind the benchmark, behind the regional benchmark, that is. And a lot of that was because of our exposure to AIM-related companies, where we did have 19% of the UK portfolio in AIM-related stocks. And in the run-up to the election last year, there was some nervousness in AIM-related companies because of concerns over the changes to the inheritance tax treatment of AIM shares. We did think that the budget rather would be the clearing event, and the uncertainty would reduce after that, but it hasn't happened. So that has been a headwind for us. The UK has also suffered from outflows, particularly from the active funds, and many of the active managers do own similar stocks. So that is something that we have had to contend with. The share price is ahead of its benchmark. The share price is up by 20.6%. So what you can see is that the discount has narrowed as well. So that has been helpful to performance. Thomas, if you turn the slide. So this is the performance over the last 25 years. You can see the Global Smaller Companies Trust is up by 8-fold over the last 25 years. And that is far in excess of the MSCI All Countries World Small Cap Index. And it is ahead of the UK Small Cap Index as well, which is up by almost 5-fold. And the FTSE 100, which has barely doubled in the last 25 years. So this is a long-term strategy, and we do have a strong long-term track record. Also worth mentioning that versus the peer group, this trust does compare favorably versus the peer group, particularly over 5 years. We do think that that is indicative of the particular philosophy and process that we follow, that we think does work well over the long term. Over the page, Thomas. So why smaller companies? Why is this interesting today? So I think throughout the history of financial markets, really good opportunities do come from areas of the market that are ignored or overlooked, and that are out of favor. And we think that small cap is in that camp today, and that has created a really good opportunity. It has been a momentum-led market. It's been dominated by the larger companies, the Magnificent Seven, and many of those other larger businesses have done really well. This has happened in the past. It's not a new phenomenon. We think this is cyclical. And normally after you have a period of large cap dominance, you do get a period of small cap reversion to the mean, and small caps do come back into favor. So we are expecting a cyclical recovery in the smaller cap asset class, and we think it can last for several years. The relative valuations of smaller companies are very low relative to larger companies, and they are at very attractive levels if you look at history. And we think that there are three clear catalysts for small caps to come back into favor. First off, we think that the earnings growth for larger companies is slowing down, and that is happening at the same time as the earnings growth picking up at smaller companies. We are seeing more M&A activity and share buyback activity within small cap businesses. There is a clear recognition that there is undervaluation within this asset class, and there are transactions now that are proving out that thesis. And we have had interest rate cuts as well. We had our first interest rate cut last year of this cycle, and that has historically been really good for the small cap asset class, and that can be helpful as a catalyst for this mean reversion that we talk about. So this trust is a one-stop shop that is a easy, simple way of playing the small cap recovery worldwide. Over the page, Tom. So if we think about the cycles in smaller companies, so the top chart shows you 100 years of data, and it shows you the relative performance of smaller companies versus larger companies. And the small cap premium is quite nicely illustrated in this chart. You can see that smaller companies outperform over the long run, and this is 100 years of data. What is pretty clear though is that it does go in cycles. So the cycles tend to be driven in many times by relative valuations. So what we've done is we put the relative valuation chart at the bottom, and we've lined up the time periods. The relative valuation is the relative PE ratios of small caps versus large caps. And perhaps I'll talk you through the last cycle, the cycles over the last 50 years, just to give you an illustration of what is potentially likely in the future. So if we start with the sort of early 1970s, that was the period of the Nifty 50 stocks. These were the large cap, one decision stocks, the highest quality companies in the US market in particular, that were doing extremely well. Companies such as Kodak, IBM, General Electric, these companies were all in their heyday in the early 70s. Larger companies were well loved, they were very expensive relative to smaller companies. Smaller companies were very cheap relative to large companies. We then had a period of 10 years of mean reversion when smaller companies came back into favor. And then we fast forward to the 1982, 1983. Smaller companies looked expensive, larger companies looked cheap. And that was the start of the LBO boom, and the craze of share repurchases really started in that early 1980s period. And larger companies came back into favor. They outperformed for 13 years. And this all culminated actually in the late 1990s with the dot-com bubble, and larger companies became very expensive at that point. Microsoft was actually trading on 55 times earnings in the late 90s, and smaller companies were very cheap. We then saw smaller companies come back into favor, and there was a long cycle that lasted till 2013. And smaller companies in 2013 actually looked quite expensive. And it was the larger companies that looked cheap. Microsoft was back down to 8 times earnings. Apple, believe it or not, was down to 9 times earnings in 2013. And that was the time to put your clients' money in larger companies. And smaller companies looked expensive. But then we've had this period of large cap dominance, really since 2013. And smaller companies have been left behind. And they are now back at those great buying opportunities on a relative valuation basis that we saw in in the early 70s and in the early 2000s. So we would be really happy if the smaller companies do come back into favor and we do get this long cycle that lasts for 10 or 13 years. Next slide, Thomas. So how will smaller companies' relative outperformance come back? So we know that smaller companies are undervalued on an absolute basis, and they do grow their earnings faster. So that is helpful. But when we look at larger companies, they do look expensive. And the charts here illustrate the point. And here we've got 324 observations on both of these charts. And what they show you is the starting valuations of larger companies, which is on the horizontal axis, and the subsequent performance, which is on the vertical axis. The left-hand chart shows you subsequent performance over 1 year. The right-hand chart shows it over 10 years. So over 1 year, there's no clear correlation between starting valuations and returns over 1 year. But in the right-hand chart over 10 years, there is a very, very clear correlation. The higher you start in terms of starting valuations, the lower your returns. And what the chart is showing you today is that for larger companies, the band of observations is between -2 and +2. So the average is about 0. So over the next 10 years, if history is a guide, we should really not expect any returns at all from the larger companies. So we think that that is one potential way that smaller companies will outperform. Over the page, Thomas. So these are the valuations of smaller companies and larger companies by region. And you can see that smaller companies are undervalued relative to their own history. The UK and Europe look like the most undervalued markets. The US looks like the least attractive market from a valuation perspective. So the top-down data is supporting what we are actually seeing from a bottom-up perspective as well. We are seeing more opportunities today in the UK market and in the European markets than in the US markets. And that is why we are overweight Europe. We have about 20% of this trust in the UK, and we're underweight the US. Over the page, Thomas. So let's talk a bit about the catalysts. So the first catalyst we think that will be helpful is the relative fundamentals of smaller companies. So earnings growth is shown on this table. We show earnings growth for last year and earnings growth expectations for this year. Smaller companies did not have a great year in terms of earnings growth in 2024. Smaller companies actually saw earnings decline of -3.4%, and larger companies delivered 8.6%. But notice where the larger company earnings growth came from. The biggest 16 companies delivered 28% earnings growth, and the companies outside of the biggest 16 delivered 3.2% earnings growth. I think the trend is something that is really important to look at. So if we look at the trend over the year, smaller companies started the year with -13% earnings growth in Q1. But then the trend improved as the year progressed. We went from -13 to just under -9, -7.6, and then we turned positive in Q4. In the largest companies, those biggest 16 companies saw deceleration in earnings growth as the year progressed. And this is to be expected. These businesses have been delivering blockbuster earnings growth over the last couple of years. They are now facing very difficult comparisons, and the earnings growth is starting to slow down. Interestingly, the earnings growth at the larger companies outside of the big 16 are actually improving. So we are seeing this broadening out of the equity market. This year, the expectation is that that trend is going to continue, and we're going to see smaller companies deliver just under 16% earnings growth this year. And those biggest 16 companies are going to see a continuing deceleration in earnings growth. In 2024, they delivered 28%. This year, we're expecting 21%. So smaller companies will be delivering higher earnings growth this year, and they are on a much, much lower valuation. So we think that that is something to get excited about. Over the page, Thomas. The second thing that we're looking at is M&A and share buyback activity. So the top chart is showing you the M&A activity over history. And normally in small cap land, you get about 500 deals a year in terms of M&A. Last year was not a brilliant year for M&A activity. It was only 350 deals happened. So it was quiet, but it was differentiated by region. We did see M&A activity in the UK, and that's shown in the bottom left-hand chart. But we didn't see a lot of M&A activity in the US. And part of the reason why was under the Biden administration, the FTC, which is the equivalent of the UK's CMA, or the Competition and Markets Authority, the FTC in the US has been very strict on M&A activity, and they have blocked many deals. With the new administration, we do think that that will loosen up, and that we should start to see M&A activity pick up. There is a long pipeline of deals, particularly when we talk to our investment banks that we have invested in. They do mention that many deals are sitting in their pipeline, but they are waiting for approval. So we're expecting US M&A activity to pick up this year, and that will be helpful for small cap performance. We are seeing buyback activity, particularly in the UK and Europe. If you look in the bottom right-hand chart, this is the deals that are happening, or the buyback activity that is happening within companies. And you can see the noticeable pickup in the red line, that is the UK market, and the blue line is the European market. So that is helpful as a catalyst for driving performance for small caps. And then over the page, Thomas. Interest rates have been helpful, in terms of interest rate cuts have been helpful for smaller companies as an asset class. The main reason why this is because smaller companies tend to have more of their debt in the floating rate markets. So they are bigger beneficiaries of cuts relative to larger companies. They tend to have less access to capital in general. So smaller interest rate cuts generally are more helpful for companies that aren't able to access credit more broadly. We did have our first interest rate cut in the middle of last year. What's interesting about that is that in the first 12 months post the first rate cut, you do see outperformance of the small cap asset class. In previous cycles, averaged out, smaller companies have outperformed by over 10 percentage points in the first 12 months post the first rate cut. So we think that that is something to look forward to. Over the page, Thomas. The question, or the pushback that we get a lot, is that we will wait for the asset class to come back into favor before investing, or we want to see evidence that the asset class is coming back into favor. Now, this is a little bit tricky because the asset class is not that liquid. And what is noticeable is in previous cycles, a lot of the recovery actually happens early on. If you look at the past UK stock market cycles or the small cap cycles, you can see how much of the gain actually happened early on. And psychologically, it is difficult to chase a rapidly rising market. So we do think that there is some merit in having some allocation to the asset class ahead of the turn, because then you wouldn't really need to buy into an asset class that is going up quite quickly, which it has done in the past. Psychologically, that is very difficult, and you are able to capture a lot of those early gains that tend to be quite strong. If you turn the page, Thomas. So we do know that there's been some uncertainty since the start of the year. We do have a new administration in the US that is very unpredictable. There is the threat of tariffs and a potential slowdown in growth. So another question we do get asked a lot is what happens in a recession? Now, smaller companies have had a history of underperforming going into a recession. During the recession itself, the performance actually hasn't been that bad. This is the previous 6 recessions in the US. The S&P 500 is the large cap index. The Russell 2000 is the broader US small cap market. And the recession return, i.e. the return that actually happened within the defined period of recession, the S&P 500 averaged a return of -6% roughly. The Russell 2000 averaged a return of -4% roughly. So going into the recession, the small caps certainly did underperform. During the recession itself, the small caps actually held in there quite well, but it is coming out of the recession that the small caps really do shine. And the smaller companies have outperformed by about 10 percentage points coming out of the recession. So we're now in this period where smaller companies have already underperformed by a significant margin. So even if we are in this recession or slowdown, a lot of this has already, the underperformance has already happened. And there is a potential benefit of outperforming as we come out of the slowdown or the recession itself. Over the page, Thomas. So this is our portfolio, and I'll talk you through some of the changes that have been made. So the way that we allocate assets is very much a bottom-up driven approach. It is a function of where we're finding the best ideas and where the valuations are of those ideas as well. Right now, we're finding quite a lot in Europe. We're finding quite a lot in Japan. We're not finding a lot in North America. It is a widespread portfolio by sector as well. So a lot of funds will have heavy weightings in technology. We actually have just under 10% of this trust in technology. So we are slightly underweight the high-flying technology sector. And we're finding more opportunities in the industrial space, which is very out of favor at the moment. In terms of changes, we have taken some profits in the materials space, which has done really well for us. We have added some holdings in industrials because that part of the market is out of favor, but we think the longer term outlook is really good because of factors such as automation, reshoring, which is another longer term trend that we think is favorable, and energy efficiency as well. In the UK, we have 20% of this trust in the UK, so we think that that is a good weighting in a market that is very unloved and very cheap. In the rest of the world, we have actually reduced that slightly. China is a little bit concerning to us. We think that there has been a pickup, but clearly the fundamentals are somewhat challenged. India does look a little bit expensive to us, as does Taiwan as well. And just to conclude, Thomas, I'll summarize on the next page. So it is an attractive asset class. It does really well over the long term. It is an area of the market where active management has a history of outperforming. And we take a long-term conservative approach to buying good quality growing businesses when they're available at an attractive valuation. This team has a lot of experience. We have over 20 years experience per person. It's really well resourced. We have 9 people behind this trust. And we have a philosophy and process that we think works really well over the long term. And
fantastic. Thanks very much, Nish. If you're in the audience, please do add your questions. We have 10 minutes or so left. Got a couple coming in, but plenty of time. Perhaps we could start with one on your highest conviction ideas. Could you give us perhaps 1 or 2 of the stocks you're most excited about?
Yeah. So in the US, we do own positions in materials companies, construction materials companies. So, for example, Eagle Materials and Martin Marietta Materials. So under the Biden administration, there was a push for infrastructure spending. And we had these vast bills that were passed by the government to spend money on roads, bridges, dams, airports, and so on and so forth. And that gave visibility going out over the next 5 years at least for spending on these projects. And we do own positions in these companies because they are large beneficiaries of the spending that will come from these projects. And they're also inherently very attractive businesses with a lot of pricing power. These companies own quarries and reserves of materials, and these reserves are basically stocked with materials that are quite heavy in weight but quite low cost. So as a result of this, the materials don't actually travel that far before it becomes uneconomical. So, for example, Martin Marietta Materials, they sell aggregates, and the aggregates don't really travel more than 50 miles because it becomes uneconomical for the customer to buy from the quarry because the transportation costs are so high. So what this means is that these businesses have local monopolies, and they are able to raise prices with very little pushback. Even in a recession, they still raise prices. In 2022, they raised prices by over 12% with no pushback from their customers because they had no alternative. So we think that as these projects do come in to construction, there will be a lot of demand for these materials, and the prices of these materials will go up, and these companies own these quarries, and they will be able to benefit from the earnings growth that will be inherent from all these projects. So these are two businesses that we are really excited about in the US portfolio.
Thank you. The question on the gearing. So it's varied a little bit over recent years, currently around 4% according to the AIC website. Can you tell us why, how you adjust the gearing, why it's moved around, and whether you expect it to rise or fall in the near future?
So we do think that it is sensible and to have a conservative approach to gearing. It is a risky asset class, and we don't want to add on more layers of risk by taking on too much gearing. But we are fully cognizant that markets do rise over the longer term, particularly smaller company markets. And so we think it's sensible to have some structural gearing in place. So we have our structural gearing of around 5% through the cycle. And this has been financed by very low cost debt that was taken out at very favorable rates. And so we do have that bedrock of structural gearing through the cycle, but we are willing to take tactical gearing up to say around 10% or so if we are in circumstances where we're seeing a lot of opportunities from a bottom-up perspective. And normally that would happen if there is some distress in the markets, potentially if earnings growth is starting to decelerate, if sentiment starts to weaken, and we are seeing a lot of good valuation opportunities, then we would be open to taking some tactical gearing.
There's a question about the potential for a pivot from mega cap growth, which we're sort of discussing in the presentation. And the questioner asks, if we do see this pivot, surely that it would have to be to a market segment with the capacity to accept those size of flows. Doesn't that argument slant towards areas such as real assets, mid caps or bonds, etc.? How do you view that happen?
Yeah, so I think it's certainly true that we will see, or it's highly likely that we will see a broadening out of the equity market. I think it's amazing that so much concentration has taken place in the equity markets, particularly in the US market, and the remaining companies have been left behind. So we think that broadening out will happen. I think it will disproportionately benefit smaller companies just from the liquidity standpoint of you don't need to move much money for smaller companies to really perform. The overall stock market, or the overall smaller companies market in the US, is less than 4% of the overall market. Historically, it's been 8% of the overall market. So you could fit the entire small cap market in the US into one of those big stocks that has been dominating. So even if you took a small amount out and just reallocated it towards the other parts of the market, it would disproportionately help smaller companies relative to the other parts of the equity markets, just because of a liquidity standpoint and just because it is such a small part of the overall market. So any kind of sharing out of total weighting across the equity markets is going to be helpful for the small cap asset class, and it will react favorably.
Yeah. On the geographical question, does the outlook for US smallers look more positive than for UK, given the divergence in fiscal policy between the two countries?
Yeah, so I think as investors, we do have to look at the fundamentals, but we also have to look at the valuations as well. And to what extent do the valuations incorporate the fundamentals? Now, the US market is well known and well loved. We know that there is likely to be deregulation. There will be attempts to cut tax rates further, or at least extend existing tax cuts. But the valuations are a lot higher. In the UK, the valuations are extremely low, and we are seeing a lot of share buyback activity. We are seeing M&A activity. The sentiment is very depressed, and we think the government is being encouraged to try and develop growth within the UK economy and to try and do something to alleviate the malaise that we're in. A lot of that will be down to the housing market. Housing is a big component of general activity within the UK. So we think that stimulus that might head towards housing could be helpful to just reignite the UK market in general. So we do like the UK market because we're seeing a lot of good valuation opportunities, and many of these businesses are actually really international. They don't actually have a lot of their revenues from the UK. Many of them are from outside of the UK, but they are being mispriced, and many investors are just not taking that into account at all. And that is creating opportunities for us.
Could you please comment on the collective holdings, the investment trusts that you own, which appear to be around 13 to 15% of the portfolio?
Yeah. So at the outset, we wanted to always provide a one-stop shop for all exposure to the very best smaller companies all over the world. And we think the emerging markets is a key component of this. Emerging markets economies are growing very quickly. They have some of the very best smaller companies opportunities to invest in. And we wanted our clients to benefit from that. We don't have a emerging market small cap capability within Columbia Threadneedle. It is a very specialist area. It does require you to know the management teams really well. It requires knowledge of the accounting, the local conventions, the rules and regulations, and an ability to travel. And we don't have that capability in-house. So we've recognized that, and we want to hire the very best small cap specialist fund managers to do that job for us so that our clients can benefit from that. So we have taken a very professional approach to picking the best funds within the emerging market small cap area. There isn't a lot of choice, but we have very good fund managers that have a similar philosophy and process to the way that we run other parts of the trust. And in that way, we can provide a one-stop solution for all exposure to global smaller companies all over the world in one vehicle.
If you're in the audience, I think this is the final call for questions as we're coming up to time. I've got one more loaded up, which is on the number of holdings. So 199 holdings currently. How can you effectively monitor so many stocks, and would a smaller number be preferable?
So it was higher than this. It was over 220 holdings. So there's been an active effort to bring this down. And we think that in order to have a broad spread across the world and to actually invest in really small businesses, so for example, in the UK, we can invest in companies that have 100 million market cap. We do need that number of holdings. It is a really high active share as well. It's an active share in the 90s. If you look at many smaller company funds on a regional basis, they do have at least 50 holdings in them. So our portfolio is actually well concentrated within each region. So for example, in the US, we have 50 holdings, which is quite concentrated. In the UK, many small cap fund managers have over 80 holdings. We have 65. We only have 40 holdings in Europe. We have 30 in Japan. So we think that the portfolios on a region by region basis are actually quite concentrated, and there are over 8,000 stocks for us to invest in throughout our universe. So having a portfolio of just under 200 is about right.
Fantastic. Thank you very much, Nish, for your presentation and for answering those questions. Thanks very much in the audience for your interest and for all your questions. Hopefully it was useful. The slides and a recording should be available, hopefully not too long, on our website if you want to watch it again. And I hope you'll join us tomorrow, where we'll be hearing from BlackRock Greater Europe. So Nish, thanks once more for a good presentation. And yeah, see you next time.
Thank you. Thanks, Thomas. Appreciate it.
Bye-bye.
Bye.